I just invested $100,000 in a single dividend stock to earn over $5,600 in dividends and nearly 12 grand total returns over the next year. Best yet, I'm guaranteed to make that unless the stock drops more than 12%. In this video, I'll show you why this is the best dividend stock strategy for 2021 and how to set it up yourself. We're talking dividend investing today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I mentioned this dividend stock strategy in one of our Sunday live streams and the comments blew up. I love using this to park my extra cash, so I thought I'd do a video showing exactly how to set it up and why it could be the best dividend investing strategy of the whole year. This one dividend stock is going to cash flow almost $5,700 in dividends and another $5,900 in profits in one single year. That's a return of over 12% and it's very low risk. I'll first show you that dividend stock and how I picked it. Then I'm going to share that investing strategy that makes this low risk return possible. I'll then show you how to recreate this using any dividend stock you want. First though, I want to personally invite you to get the Daily Bowtie, my daily market update that's going to give you all the trends, strategies, and important news that you need to invest your money. It's completely free, just something I like to be able to do for all you out there in the community, and it's completely new this year. I'll leave a link in the video description below, so check that out. So we're here in one of my accounts on E-Trade, and if we scroll down, we see my favorite dividend stock right now, Chevron Corporation, ticker CVX, and you can see I've bought 1,100 shares worth just over $100,000. And you see just below that, I've sold 10 call option contracts. Now those call options expire in January 2022, about a year from now, and have a strike price of $80 a share. This is called the covered call option strategy, one of the 5 that I talked about in a recent video. I'll describe the strategy here, but those options are amazing tools. I'll leave a link in the video description below, so make sure you check out those other 4 strategies. And first here, I want to explain why Chevron is my favorite dividend stock right now and why I picked it for this strategy. Chevron is a solid dividend payer with a 5.6% yield and has increased its payouts for 33 consecutive years, which is even more amazing considering oil companies have been slammed for the better part of 6 years. The price of oil actually went negative last year and the company's still committed to that shareholder cash return. But here, a good dividend stock just isn't enough. If I'm investing 100 grand into a stock, I want to go deeper into the analysis and make sure that big picture is going to support it. And all you out there in the nation, you know energy is having a really good year. Stocks in the sector are already up 37% in the last 3 months, and I think oil prices could approach $60 a barrel before OPEC brings some of its production cuts back online. Economic growth in the US this year is expected at 5%, with global growth even higher. Inflation is expected to pop higher, with short-term interest rates anchored near zero. That means the dollar is probably going to fall even further after declining 12% since March of last year. Now, since oil is priced in dollars, a weaker greenback is also going to mean higher oil prices. So there are some real strong economic factors driving that entire energy sector, and Chevron is one of my favorites in the space. Now, some great research here by Morningstar shows the estimated break-even price for big oil companies, and Chevron is one of the lowest cost producers along with Total and RDS Shell. Those red dots here are estimated break-even production prices for this year. And Chevron needs the price of oil at just $50 to turn a profit. That's 5% lower than the current price of WTI crude, and those market fundamentals should push it even higher. You can see that earnings were absolutely crushed last year, but are expected to rebound steadily to $3.82 a share this year and to $5.29 per share in 2022. Now that should be more than enough to support the share price and, more importantly, the cash flow for that dividend. So I really like the backdrop for Chevron. It's a well-run company with a strong economic tailwind, and I can confirm that with other analyst targets. And here we see the average price target of $104 a share over the next year. Now, even that lowest target, though, at $90 a share is just under where the stock is trading now. Now, I want you to understand, I wouldn't suggest just going off these analyst price targets for a stock. Now, these are meant to confirm your own research, not just blindly invest in what the analysts say is a good stock. So I picked my dividend stock. Now I want to show you that strategy, why I'm using it, and how it works. First, though, I want to get your opinion on this too. Which dividend stock do you think would be perfect for this strategy? What dividend-paying company offers a good yield, a strong outlook for the price, and then relative safety from a market crash? So scroll down and tell us in the comments below, what's your favorite dividend stock and why? Now, the covered call strategy is an option strategy that can not only lower your risk in a stock, but also cash flow on your investments. You sell a call option to another investor, and that premium you collect is like an instant dividend. Of course, the downside to this strategy is that if that stock price is above the strike price on the option, you have to sell the shares for that amount. But I'm using this strategy more for cash flow and protection, so I'm not really worried about that right now. So let's look at this dividend stock investment, and I'll explain what this means. Here I bought 1,000 shares of Chevron. I already owned 100 shares, so that's not actually part of this strategy. But at the same time, I sold 10 call option contracts. Now remember, each option contract is worth 100 shares of stock, so these 10 contracts cover my 1,000 shares completely. You see that the option has an expiration date of January 2022 and a strike price of $80 per share. That means whoever bought those call options from me, they have the right to buy those 1,000 shares of Chevron from me for $80 a share from now until January of the next year. And for that right, they paid me $16.24 per share immediately. So let's look at this. Unless shares of Chevron drop 13% by January, I'm going to be selling those for $80 each, which sounds like kind of a crap deal considering I just paid $91 each. But here, let's look at my actual cost. If I paid $90.87 and immediately collected that $16.24 per share, I actually only paid $74.76 per share. If I then sell the shares for $80, all I've made is 7% even on that price. Add in the 5.6% dividend yield over the year, and that's a solid 13% return over the year. And now the reason why I set this up this way is because this is my cash investment. I'm not buying a lot of stock lately because everything is just so damn expensive. Take a look at this research by FactSet. The dark blue bars here are the current PE ratio on a forward basis. So the price investors are paying per share for earnings expected over the next year on those stocks. The green bar here is that 10-year average PE ratio. And you see, every stock sector is trading way above that long-term average right now. And sure, some sectors like the financials are trading a little bit cheaper. Bank stocks and others in the financials are trading for 15.3 times that forward earnings versus the longer-term average of 12.4 times. But even that's a 23% more expensive than that average. And then some of these sectors, they just look ridiculously expensive. Look at tech stocks trading at 27.2 times on that PE basis, more than 66% above the 16.3 times average ratio over the last decade. So now starting this year, I was sitting on nearly $300,000 in cash, and I didn't want to put it in those traditional safety investments like bonds or stocks in the utility sectors. With interest rates rising, those might not be the safety plays that they used to be. But now here with this dividend stock strategy, I can park my cash, get a 13% return and a big downside protection against that market drop. And here you can see what kind of protection. Shares of Chevron could drop 13% and I would still make my max return. Shares can drop to $80 a share and it's all the same to me. But if we take that price I paid, the $90.87 a share, minus the cash collected of $16.24 for my real cost basis of $74.76 a share, we see that shares would have to fall 18% for me to start losing money on this. And even with that, I would still make money on the dividend. Shares of Chevron have only briefly closed below $80 a share 3 times in the last decade, and 2 of those were in the chaos of last year. Now they have that strong economic backdrop and rising oil prices to support them. And the thing is, I really like Chevron as a company, so I'd be fine holding those shares even if the stock price dropped below $80 each. I could then sell another call option against them to further cash flow and keep collecting that dividend. Now, I do want you to understand, I'm not putting all my free cash in just one stock. I have about 5 stocks that I'm doing this with and investing between $30,000 to that $100,000 on this strategy. It's a great way to keep that market protection while you wait for the market to come down, earn a strong dividend yield on some of your favorite dividend stocks, and just put your cash to work. And you can use this strategy with just about any dividend stock you like. Like I did, you can pick a dividend-paying company with strong fundamentals and that good market backdrop that should support the entire sector. You'll do your research and pick a price on the shares that is well below the current price. Now this is where you can really play around with the strategy a little. Now I wanted maximum protection, so I went with that price on Chevron that has some major support, and it's not likely the shares are going to make it down to that point. Remember, this is my cash strategy, so I just want to make that decent return on that cash. If you want a higher return though, and you're willing to give up some of that protection, you would just pick a strike price on your calls that is closer to the current price, or maybe even above it. You'll then go into your options trading page on whatever investing site you use. Now for this kind of all-year strategy, I usually pick the options expiring in January of the following year, but you can use options from pretty much any month. And you can see I can sell options from any strike price here. The column marked last on that right side is the last price at which those options traded, and the bid-ask prices are the current prices being offered. Now to make the trade, I open up the order screen, and this is going to be almost identical on any investing site. I'll add a stock leg to this, so I'm buying the shares of stock and selling the call options at the same time. I want to buy the stock and then use a sell open order for those calls. Now that means I'm opening a sell position on the call options. You can change this quantity to whatever you want to invest. Remember, each option contract covers 100 shares, so you have to buy in those multiples of 100 shares. Here I'm buying 1,000 shares and selling 10 options contracts. I can see the price per share is $91.73, and the bid ask for the call options is right around $16.20 each. So if I put in an order to buy the stock and sell the options at that midpoint, it's going to cost me a net debit of $75.53 a share. But we'll put this order in for $75.50. Maybe we'll save 3 cents each, right? Now that's going to cost me a total just over $75,000, and at that price, gives me a cushion of almost 18% on the current share price. Shares could drop 18% from here before I lose any money. Click on the video to the right for those 5 options trading strategies I use. 5 strategies to protect and grow your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.